Hi, this is Mike Larson from Money and Markets TV. Despite the decisive result of last week's presidential election, a lot of uncertainty remains in the markets. President Obama and House Republicans are very far apart on negotiations over the fiscal cliff, and the European debt crisis continues to devolve. The Eurozone is now officially back in recession, and anti-austerity strikes are sweeping over the continent. But there is one relatively bright spot in all of this gloom: the U.S. real estate market. Following the worst collapse in the country's history, home sales, construction, inventory, pricing, and virtually every other metric are improving. But I believe that optimism over the real estate recovery is not completely warranted. For one thing, we're still far below the levels of activity we saw during the bubble in the mid-2000s. For instance, housing starts are running at an annualized pace of 870,000 units versus 2.2 million units during the bubble. In addition, the Case-Shiller index of home prices is rising at about a 2% rate, but that's nowhere near the 15 to 17% gains we saw back then. But my biggest concern is not that the industry isn't recovering fast enough, it's that the recovery is being underpinned by some extremely risky practices. You see, real estate is getting swept up in the same yield insanity trade as other asset classes. With treasuries and savings accounts yielding next to nothing, and the Federal Reserve artificially suppressing interest rates, income-seeking investors are desperate. They've been dogpiling into anything and everything that yields more than treasuries, including emerging market bonds, junk bonds, real estate investment trusts, and of course, physical real estate. In fact, the National Association of Realtors reports that 27% of home buyers last year made their purchases as investments. That's far above the 17% rate of the previous 2 years, and only 1 point shy of the all-time high of 28%. That record was set in 2005, right before the market crashed. I'm also seeing some troubling signs in those real estate investment trusts I mentioned. REIT stocks had a blow-off top in September, created by Ben Bernanke's promise of QE infinity. But since then, the benchmark ETF for the sector, the iShares Dow Jones U.S. Real Estate Index Fund, which trades under the ticker symbol IYR, has been falling like a rock, and it's now at its lowest level since late June. These indicators make it obvious to me that Bernanke's strategy of trying to inflate asset prices far beyond their intrinsic value is failing. And it also means that investor sentiment could easily sour on real estate again, taking some of the steam out of the recovery. That's why my advice remains the same as it's been for months. Lighten up by taking profits and put some protection in place with select hedges. If you do that, you'll be sitting pretty through this pullback. We'll know very soon if it's going to get worse, and if it does, I'll have more recommendations to profit from it. I'm Mike Larson for Money and Markets TV. Thanks for watching.